Welcome back, everybody, to the Four-Star Wealth Today's Market Explained podcast. And today we're continuing with our interview series. We have a really interesting discussion planned today with Richard Hillson. And Richard is a gentleman I met recently at an alternatives conference. We became good friends and started talking about the industry and how the alternatives industry needs a lot of work to make sure that folks understand it better. Anyway, so Richard's here to discuss all those things with us. Richard, welcome to the Four-Star Today's Market Explained podcast.
Thanks for having me.
Glad to have you. And just by way of background, Richard is a financial services entrepreneur and an expert in the area of alternatives. Over the years, he's worked with many investment advisors and gatekeepers of institutional quality product. Before founding Hillson Consulting, Richard founded Third Seven Capital, a privately owned boutique investment bank, and you're also the CEO of an RIA aggregator, right? At one point, Richard.
Yeah, that's right.
So Richard's British, and British national. He began his career at Barclays, and you've gravitated to the United States, and you have an investment management certificate in the UK. You have all the series rankings 17, 24, 63, 65. And you've generally been in the securities industry, but you pivoted at some point with Hillson Consulting over to working with alternative investments. So did I get the background right, Richard?
Yeah, that's right. And it was having run what started as a private equity shop and turned into kind of a boutique alts, more general alts firm. I saw the issues with misunderstanding in the alt space, a need for some education, hand-holding, because I'm always terrified when I see clients who are in the old 60-40 model exclusively, and I felt there was a need in this space to actually further the cause of alts. So that's when I set up the consulting business, and I believe that alternatives are underrepresented, need to be a part of every portfolio, and are pretty misunderstood sometimes. So how do I further the cause of alts and help that situation?
Yeah. So tell us, why don't we dig right into that? Why are alternatives misunderstood and underallocated?
So the number one thing, and if I get quite animated speaking about this, is because it frustrates me on almost a daily basis.
Well, you're an animated guy. That's okay. Yeah, that's okay. Yeah.
The terminology is the first problem, is the fact that alternatives can mean anything from Bobby Axelrod from Billions, high octane black box hedge fund volatility strategies, strategies which are very volatile, all the way through to commercial real estate triple net lease, antiques, cars, whiskey, oil and gas. It's such a broad terminology. That is a massive problem to begin with. And therefore, I can't tell you how many times each week I have the conversation where I say alternatives and the dreaded A word, shoulders tense up, people seem terrified by it because maybe they've had a bad experience with crypto, or maybe they had a venture deal that went wrong and they write off all alternatives because of that. Well, okay, don't do crypto again if you don't like it. Don't do venture again. But why would that stop you from doing oil and gas or real estate? It's just this broad terminology means that the perception of alternatives is kind of defined by what people deem to be the riskiest side of that. Whereas it's not the case. Like other asset classes, there is a broad spectrum of volatility, risk, return, where you just can't generalize in the way people do about alternatives. So the name itself, the definition, is a real problem in the space.
So in our discussions, though, we've talked about how things are changing, and we both agree on that. Where folks are starting to understand alternatives better, although the nomenclature issue is still there. How have things changed, at least in like the last, well, maybe not during the pandemic, maybe somewhat, but in the last 5 years, let's say, and then coming out of the pandemic?
Yeah, so custody and reporting has got a lot easier, and we will talk about some of the barriers to entry as well. But a lot of advisors think, oh no, if I make 6 different alternative allocations? Do I need 6 different custodians for that? Something like that. And again, that's, that's real time that gets eaten up by things like that. The custody has got better, even though some of the big boys on the custodian space still charge these ridiculous $400 fee per holding kind of thing, which that's horrendous.
It's crazy.
There's plenty of friendly alts custodians. I use NewView myself, and I'll say to advisors, well, okay, it's not as simple as just one, but if you've got your regular TD or Fidelity or whatever custodian, and then you've got your alts custodian, is it really that much of a headache now? You've got 2 custodians. And by the way, you've got your alts there and aren't being charged these exorbitant fees on each individual position. So that has improved, which has opened up the industry. I use the analogy when I'm speaking that alternatives used to be for the Amex Centurion card, which I think you need to put 250 grand a year on that card or something alone to get that. So that's pretty ultra high net worth there. To now the Amex Platinum card is a normal high net worth investor who is just accredited, has now got access to quality alternatives, and they didn't used to have. So the industry has opened up, and part of the reason for that is the minimums are dropping all the time. 5 years ago, to have a decent alts portfolio at 250 grand minimum ticket size, you'd probably need $1 million into alts alone to get 4 different alts holdings, which
just
means
to diversify.
which means your liquid net worth probably needs to be in excess of 5 mil for you to allocate $1 million to alternatives.
Exactly.
At 25 grand minimums for quality product in some cases, yes, quality product, but in some cases as low as 25 or even lower. Someone can have an alts mini portfolio with 100 grand and 4 allocations of 25 each, which means you're now looking at the people that have a liquid net worth of maybe $500,000 or something. So we've gone from the Amex Centurion to the Amex Platinum. Is normal high net worth accredited investors can now get access to quality institutional product, which previously they just wouldn't have been able to do, because if someone's got, if you as an advisor say, let's allocate 250 grand to alts, that's the right slice of your portfolio. Previously, that's one alts allocation. That's not a well diversified portfolio. So the landscape has changed. The custody reporting and all of that are improving all of the time. So it is opening up the industry in a very positive way.
So Richard, I've felt for a long time that people tended to do too much concentration, as you're saying, in the alts world. And we would never do that in our stock portfolio, but we do that in alts, don't we?
Yep. And that's changing now, so that sorry, I've got a cat jumping on my knee here while and it's a white cat, so I feel like a Bond villain with a white cat on my
there knee. You go. Yeah. For all you cat lovers out there, Richard's your guy. Okay.
There we go. This opening up and the lower minimums means you can get diversification because for a lot of people, 250 into one thing as the alts portfolio that's just too much. And I promote diversification away from the 60-40 model, but then also diversification within the alts portfolio. So progress is being made, but we've still got a way to go.
So one of the barriers was the minimums are too high. Now the minimums are going down. What other barriers are there to allocating a diversified portfolio of alternative investments?
Yeah, so we've talked about the custody and reporting, which can be a little cumbersome, but is getting better. I honestly don't think that having all of your alts with one alts custodian and saying, do you know what, why don't I bill quarterly, even though I bill monthly on other stuff? I don't think that's too much to ask. The benefits, the juice is worth the squeeze on that side of things. The minimums are lowering, which gets rid of a lot of the barriers to entry. I think the main thing still is I'll say perceived risk, and then the perceived regulatory risk is advisors assume, again, based on this broad terminology, often assume that alternatives are at the much more risky end and volatile end. So they actually think this is too risky to put my clients in. That's not often the case, but goes back to this terrible terminology problem that we spoke about. And then it's the perceived regulatory risk is in a next audit, how am I going to explain this? If I've chosen this REIT over this REIT, how do I do that? Well, the point is just make really good notes of the rationale, the fees, whether you've charged as a Series 7 dual reg, whether you've done it under a wrap fee, whether you've charged a diligence fee for something like a DST, as long as you've made notes actually explaining your rationale for recommending and also the way that it's billed, I don't believe that's a problem there. But people get nervous about that. And I understand why, because they think that anything non-plain vanilla in the portfolio is going to cause a regulatory issue next audit. But I don't believe that should be the case as far as that's concerned. And then we have the issue with the messaging to clients. You sit down with a client who, oh no, alternatives, that's much too high octane for me. How do you actually message this and help the client understand? So if you were doing a triple net lease Amazon distribution facility paying a 5% yield, what is really the risk there? That Amazon are going to default? I'll take that all day. That's less risky than a lot of stock market positions. It's the messaging to clients, the hand holding and getting clients comfortable on that side of things. And then the other thing that we see all the time is if someone dials into one of the alts portals or one of the alts third party sites, they might type in opportunity zone and see 100 opportunities, and suddenly your head's spinning around like the girl from The Exorcist, just overwhelmed by the amount of things out there. How do you navigate that? So a lot of work that I do is helping, okay, there's a lot out there in this market. How do we find the good ones and the best fit? And the third-party diligence firms, the Bowmans, the FactRights, the Mick Law, are doing a great job by helping condense the information, making it more accessible, and by the way, giving us regulatory air cover as well by having the third-party reports that help advisors sleep better by having those in their diligence file for the next time the regulators come round. So these are all some of the barriers which are slowly being eroded, but we've still got a way to go as far as that's concerned.
Yeah, we do. We really like the portfolio approach at 4-Star, where we just placed a big real estate portfolio with 6 positions, and then an energy portfolio with 3 positions. So I agree with you. It should be well diversified and well researched with programs that have third-party research, corroborating ideas from someone else as smart or smarter than you. And that's really great. And you see that now, and we've met at these conferences where we do learn all those things. So it's really great, and I can see how there's really great value add in what you're doing, because there was so much confusion in the alternative space, and of course there's always 1 or 2 big problems in the industry where some deal doesn't work and everybody gets hurt, and then they put too much money in it and all those kinds of things. So these are all the things that will limit those barriers to entry, Richard. No doubt, right?
Yep, and we are on an upward trajectory. I think we are close to the hockey stick in terms of we get to the point where the alts market opens up. I wouldn't advocate for a crowdfunding style just opened up across the board. I get frustrated when I see athletes promoting crypto on TV, because I think crypto it has its place, but I think it's a potentially dangerous asset class for people who don't know what they're doing. I've got friends who've lost 40, 50 grand in a day on volatility on crypto because they don't know what they're doing. So I think things need to be tapered along the way. We need to make sure that the protection is there, the understanding is there, rather than just opening up the wild, wild west kind of thing. But I think we're at the hockey stick curve moment where the alts market is going to just continue growing and accelerate from where it is, because it is now open to a lot more investors. And advisors such as yourself play a vital role in making sure clients understand this and are choosing the right options and making the right allocations. That's where the advisors come in, and so important because the crowdfunding just opening up the doors to everything, that has problems associated with it.
So the advisors need to learn as well. Well, good. So On that note, then, what kinds of things do you see out there right now that are really unique and different and exciting in the alternative space? Let's talk ideas.
Yeah, sure. So I'll actually just going into that, lead into that, if I may, as to why this space is really important, and then
Yeah,
that
yeah, sure,
leads in well to
sure.
the things that I like is you look at the endowment models, and they've got over a 50% allocation to alts typically. I'm not
Hmm.
saying that clients should have a 50% plus allocation, because guess what? These guys have got huge teams of the smartest guys in the world in this space doing that, and advisors and clients often don't have those kind of resources. But the endowment models are very, very overweight in alts. So if the smartest guys in the room are doing it, it's a pretty compelling reason to do that. The diversification away from the 60/40 we've spoken about. One thing that terrifies me at the moment is the 60/40 guys, because the bond markets have been such a disaster recently. I see some guys who are moving to 70/30, or God forbid, even 80/20. The problem there is that not only are we long overdue a market correction at some point after 10 years of amazing performance, but these guys who are moving from bond allocations to even more overweight in equities are exacerbating that overheating. So they're actually
Yes.
contributing to the problem. So the returns that you can get in the space, I think, are a great replacement for bond yields potentially, rather than going more into equities. You
Hmm.
can see anything from 5 to 15% in some alternatives, depending on the type of product. And I talk a lot about the illiquidity premium, which is if you've got a private REIT and a public REIT, and they're exactly the same, other than one's liquid and one's illiquid, which one are you going to go for? Of course, you're going to go for the liquid one. So the private, less liquid assets need to give you a serious premium to make you choose them over the liquid option. Um,
Right.
in a lot of cases, that's pretty much double what you'd get with a liquid security. So
Yes.
by no means advocating putting 80% of money in a liquid asset. But if
Hmm.
an advisor knows their client's time horizon, knows what they need as emergency capital, or plan the next 10 years for them, um, I think you're doing a disservice if you're not allocating to some illiquid things, because you get twice the yield in some cases. So with
Yes.
careful planning and understanding, you can milk that difference in the marketplace. So I really like yield plays. I like illiquid yield plays. You can get a better yield on them. I like hard asset backed. So we're talking typically, I mean, commercial real estate with a nice yield at the moment that might be a 5 year play. You can get a lot better than you can in most places for yield. So that's a generalization. There's a lot of things that I'm looking at, but that hard asset backed yield play, which I think should be replacing the bond allocations in portfolios,
Hmm.
um, rather than typically, I think the alts allocation has come from the equity side of the allocation. So
Great.
that's kind of my general thought about that. But the alternatives are so important for diversification, and competitive advantage slash disadvantage is that clients are getting smarter about this. The media really
Yes.
helps with the knowledge. Clients are asking about DSTs and OZs, whereas they might not have been in the past. If an
Hmm.
advisor doesn't have access to quality alternatives, guess what? Their competitors do. If
Yeah.
an advisor has access and they suggest a DST or an OZ to a client, and the client did not even know that existed, they're going to name their firstborn child after you for saving them so much in the potential tax situation there. So
Yes.
it's a competitive advantage for advisors to be clued in on this, aside from the obvious diversification and, in my opinion,
Uh-huh.
overheated equity market.
So, Richard, you mentioned, that the competitor down the road might have more product than your firm. So, what is the story there as far as firms? Is the independent space, in your view, better for alternatives than the big broker space?
Yeah, so it's a double-edged sword. Is the large national platforms um, don't tend to be particularly flexible on onboarding new products and things like that. It can be a long,
Hmm.
drawn out process. And I get it. They've got more compliance risk, more reps working remotely around the country. So I get that. But I don't think it enables them to be nimble. And a lot of the big firms are really stubborn and compartmentalized with their thinking. Whereas a firm like yours that can be nimble, move quickly. You see something at a conference and say, wow, that is so compelling. I need to be in that space. You can move quickly and nimbly. And now that we have the third party reports and things like that, it enables a smaller team to get comfortable with something without needing 20 guys doing diligence in the background. So it's a double-edged sword. The platform gives a lot more resources, but it also, I think, makes it clunky and like turning around a battleship sometimes in terms of, just the speed. So I think the independent firms have a pretty decent advantage to be nimble. And I mean, we see it all the time with the DST market. Is a DST's out for a week and it's already oversubscribed on a 50
Yeah,
million.
they're like hotcakes.
There.
Yeah,
Yeah, large firms can't
yeah,
get there in time for that kind of stuff. So it's a
right.
double-edged sword, but I think advisors are well positioned with the resources to move nimbly and not be bogged down in bureaucracy sometimes like the larger firms.
Nice. So in this case, smaller is better, more personal is better, which is great. You mentioned earlier crypto, and there's all kinds of talk about crypto. And last year, 55% of the people that were invested in crypto at the year end had bought it that year. So a lot of new Johnny come latelys into the crypto market. Do you see any room, maybe just as one element in a portfolio, or are you not excited about crypto?
I've changed my mind to some degree about crypto over the last 6 months. Is originally,
Mm,
and this still holds true, is I had to be very careful about my messaging. Is that if I sit down with advisors and clients and say
mm,
alternatives don't have to be high octane, they don't need to be volatile, they can be predictable, stable returns. By the way, have a look at this crypto opportunity. It's
right.
completely contradictory. So when I first start working with advisors or clients, I will tend to stay with the pretty conservative. I often joke that REITs are the gateway drug. Basically, is let's start with some things that are easier to understand, more accessible. But for more sophisticated advisors, more sophisticated investors, I think crypto potentially has a place just because um, the the returns have been obscene and no one wants to miss out on those. But you need to know what you're doing. You need to be prepared to take on the risk. And what worries me are these kind of every week there's a new crypto of the week which maybe has 2 weeks in the sun, and if you time it well that's great, but it's so the space scares me. But there are teams out there and sponsors who are real experts in this space, and so I think it can fit into a portfolio, but you need to know what you're doing, and you need to work with the right team. Unless, let's be honest, is some clients actually really like almost the gambling experience and say, I'll put 30, 40 grand into something. I'm not really bothered about it. This is something that will be fun. Sure, but know what you're doing and be prepared for the risks there. And I really don't like the fact that these commercials all the time with celebrities are pushing it to the everyday investor. And I don't think the everyday investor is ready for it.
It's scary. Yeah. We've had a number of experts on our podcast talking about different ways to invest in cannabis, infrastructure, growing, cultivating, retail, CBD, derivatives, all kinds of different things. What do you see there, Richard?
Yeah, that's another space that I think. I mean, some states are coming onto the map, so there are still opportunities.
Hmm?
But when I was in my kind of private equity days, is every week I'd have someone pitching me. We've just got. We know someone inside. We're going to get the license, and only 10's going to be issued in this area when it gets legalized. Um, and we know the guys. We can get in on the ground level, things like that. And I hear all these people. Well, which one of these is actually telling the truth? Because you can't all be guaranteed to get these permits and things when they come out. So there's areas. We did a project with one in that space a while ago, and that worked out really well. But again, that's another space. Anytime something is sexy and topical and everyone's talking about it, it worries me just innately, because that
Right.
means people will start flooding into it, and you get bad actors, you get cowboys. So the more sexy and topical a space is, the more due diligence you need to do to make sure you back the right one. I've seen, if you remember, the EB5 space was an absolute
Yes.
disaster. It was so topical, and there were so many frauds going on in that space because when something is the sexy new scheme or whatever, people flock to it if there's money to be made, and not all of these are good actors. So I always
Yeah.
think the more topical something is, the more due diligence you have to do
Right.
to back the right team who know this space and have been in it for years, rather than someone who was a Wall Street broker and now thinks they're a crypto or a cannabis expert or something like that. Is
Yeah.
caliber of the team are the most important thing.
Well, it's interesting, in at the conferences that you and I attend, there's always, long lists of different real estate programs, and real estate is it's about 50% of all the alternatives that are done. Where multifamily, home building, apartment building, manufactured housing, warehousing, every form of commercial real estate.
Yep.
So once we get through real estate, what other things? We talked about crypto, we talked about cannabis. What other things are out there like wireless assets and things like that? I mean, maybe give some insight to our investors.
Yeah, sure. So I love one of the sponsors that we bump into all the time. They're in digital infrastructure. So
Hmm.
I've heard it described as a real estate play, but with a potential tech upside. That sounds about right to me. Is
That's great.
hard asset backed. It is leasing the data centers, but equally, um, because of the type of real estate, digital infrastructure, there is a lot more, in my opinion, um, opportunity for capital appreciation as
Hmm.
opposed to something which is like an industrial or something. I'm not beating up on industrial because I'm generalizing, but
Hmm.
um, tech real estate feels like it's
Hmm.
got to have a better potential capital appreciation upside than other
Hmm.
asset classes. Oil and gas, there's a lot of tax efficient oil and gas programs out there. Um,
Hmm.
I think we need to see how things pan out with oil prices at the moment, given what's going on in the world.
Hmm.
I'm sure these these guys are, well, not loving the situation which led to it, but loving the actual oil price at the moment. But is that sustainable? Um, I've looked at some private credit situations at the moment,
Hmm.
which I think there's some really attractive yields to be had there. But again, it's doing the diligence on how the team selects these and whether they have liens on them, asset backed, etc. Um, and then I mean, what other? I mean, and then all of the tax structures, which are really compelling at the moment. Opportunity zones, I'm a big fan of. The 1031 DST side of the business is. I mean, that's probably what 40% of the sponsors I think that we see have some kind of DST or OZ, if even more than that. So there's a lot of areas I like, and then you start to get more niche. So it's not just commercial real estate land. Maybe it's land entitlement, zoning and permitting before flipping to a house builder kind of thing. That's a bit more of a niche area, but I think that's really attractive. And then a lot of advisors are still looking for how they get private equity allocations. Is that area can be a bit dangerous because a lot of advisors and clients have been burned with, well, we did a venture deal. Well, of course, venture is certainly at the very risky end of the spectrum. But however much I think that there are some pretty inflated valuations in the space, the secondary market, there's a number of platforms which allow advisors and clients to go into a fund of these pre-IPO unicorns, as they call them, in the secondary market, or individual opportunities. Is I've known even years back, Peloton, Uber, Lyft, all of these kind of things, all were available for actually individual investments. And that's the kind of thing that I think actually open doors in conversations with clients, because if you can put something in front of a client that they hear on the news and see their commercials every day, it's pretty interesting.
Yeah.
But that should be a small part of the portfolio, because I've had conversations where clients say, "Oh yeah, Airbnb, we used it ourselves," et cetera, et cetera. Is
Right.
they can over allocate based on kind of irrational excitement investing at that
Huh?
point. So, but I think it forms a part of the portfolio, and the returns are certainly there if these valuations hold up, which is a whole separate conversation. But
Richard, have you looked at the angel investing, early stage, seed round capital? What kind of investors are the right ones to do that space?
yeah, I did a lot in that space in my previous life in the kind of private equity world. Um, I think that I always think that angel investing is best when it's a value add component. So
Mm.
um, if it's an investor that has, let's think about it. If it's an investor that has made their money in logistics, so some kind of um, trucking, transportation, something like that, and they see an opportunity which is actually right in their sweet spot. So not only do um, they're able to invest in that, but they're also value add. Is they know the space, they know how to diligence it, and as well as putting money in, they can actually provide value add. Well, guess what? Here's what I'd tweak on your business plan. Here's I can open up these doors for you. These kind of thing. I always think that angel investing where there's a value add component because the person knows the space and can really be accretive to it is the best way. That's not always the case, but that's the perfect combination for me in those kind of spaces.
Interesting. Well, great. Um, how did you get to this level? What were there any motivations or mentors or folks that led you in this direction? Like how did you decide to come into the alternative space?
Yeah, so I worked in kind of boutique investment banking. I moved over to New York in 2009. I moved to Manhattan. So I was 29 at that point. Um, and I worked for a firm for a couple of years. And then myself and a guy I worked with said, let's set up the investment bank. We can do this better ourselves. We were in the private placement, private equity kind of world. So we actually
Uh,
started the process to set up the firm when I guess I was 30 when we started that. So I was pretty young at that point. We had a really good advisory board, which really helped because I can have an ego sometimes, but I also at 30 years old knew that I was taking on a serious undertaking and needed to, surround myself by a good advisory board. But it was really just kind of trial and error through the early days of that in the investment banking world is you see deals that work out, you see deals that don't work out. And because I'm diligencing opportunities and interviewing management almost all day, every day in that side of
yes.
things, I think I understood the diligence process, but also saw how the alts market was growing and thought, this is what we're
Mhm.
missing here. Um, I I never claim to be the smartest guy in the room. I'm far from it. I think my accent maybe makes me sound smarter than I am, but I'll hold my hands up and own that. Is I'm a generalist. Is I'm about messaging, communication, education, that side of things. How do we take
Right.
alternatives as a broad concept and make it more accessible? Now, I have lectured and done presentations on like just opportunity zones, just DSTs, but I'm not a tax expert. I'm not someone who is going to sit there and debate mathematical correlations or lack of correlations between different types of asset class. I'm not a mathematician. I went to law school. I'm a communicator. So I'm far from the smartest guy in the room, but I think it's about the messaging and communication, which is what we need to get better at in general. And then I surround myself by people who are experts in individual areas, and pull someone on if we want to go really deep into the tax side or something of opportunity zones or DSTs or whatever. So I'm a bit of a jack of all trades, but for me, it's about the messaging. So I know that was a long-winded response to your.
Yeah, no, that's great. Well, so now that we have a more organized alternative space and we're seeing lots of investments that weren't there before, you must see new ideas all the time. Are there things that are in the offing that are not really out there yet that investors can look forward to in the next couple of years? Pandemic is over. Maybe we'll see some new opportunities.
Yeah, I mean, I'm seeing some interesting structures. Is I think people are structuring things differently and getting creative with the structure, which I always enjoy. One of my favorite um, sponsors at the moment actually have a bond, which is their kind of quick money, which is backed by their REIT, but they have a 9% 12-month bond, which is their quick deployment capital. They see something, they need to move quickly. They use that money. I think it's a 10 grand minimum or something like that. And it's backstopped by the REIT, and the REIT basically repays the bond. That's really creative. It enables the sponsor to move quickly, to actually get things at under market prices. And for the investor, that's great. Is a 9% 1 year bond, which is backstopped by a multi-hundred million REIT. So we're always seeing creative structures. I don't think there's many more asset classes that we can see, but I think people are getting more creative with their structure, and I think are giving more options as to. It used to be just a case of, in real estate, do I want commercial, retail, industrial, digital infrastructure, and that was kind of it. Now it's all right. Well, if I want to go into industrial, here's 3 different structures I can choose from. One is
Nice.
yield heavy, one's cap appreciation, one's a hybrid. So
Hybrid.
more share classes, more flexibility in terms of the structure. So I think the creativity will be more on the structure side of things rather than the asset classes, because crypto kind of came out of nowhere, but no one can predict what the next new asset class is going to be. But I think it's more about the structure where we'll see the creative thinking.
Until it happens, yeah. Well, good. Well, we've covered a lot of ground here. This has been great. Before we end today, are there any other messages you'd like to leave with the investing public about alternatives in general and your expertise?
It's just is. I think if I had to boil it down to one point, is this: don't generalize based on the terminology. If someone's had a bad experience with venture, don't write off land or oil and gas under the alts umbrella. And spend some time to get more familiar. I do a lot of presentations for different sponsors. For other things, I'm doing a keynote speech next week for Blue Vault Alternatives Week, and also hosting a panel. So anyone who kind of wants to learn more, connect with me on LinkedIn, Richard Hillson, Hillson. And I am always putting out free content and things where I'm presenting. And, this is a space that everyone needs to be up to speed with. Please, take the time to get up to speed with it and hopefully learn something. And if you don't get sick of my face or my voice, you might be able to, get some insights there. So this is just free education to actually just further promote the alternatives cause. So I would say to people, advisors and clients, start spending some time on an asset class that needs to be in your portfolio, and don't generalize or kind of tarnish everything with one bad experience under one small vertical within this whole alts universe.
Yeah, that would be like you have one stock that goes down and you hate all stocks.
Yeah, right. Seriously. Yeah, right. Exactly.
You wouldn't do that, true. So don't do that here. Yeah, exactly. Well, great. Well, this has been really great, really fun, and maybe maybe we can do another check-in in 6 months to a year, and see if there's new things we can talk about and new things on the horizon. And if you're up for that, Richard, we'd love to as well.
No, I would love to do that. Always here, and we can go into a lot more detail on various things. We've kind of glossed over a few, which is great. So happy to come back, and really appreciate you having me on. And I'll see you on the conference circuit in the next couple of weeks as we seem to see each other regularly now at the different events.
Absolutely. Well, thanks, and everybody again. This has been Richard Hillson of Hillson Consulting, and learning quite a bit about alternatives and alternative investing, which I think really should be part of most investors' portfolios, and even small investors can participate now in ways that make sense, diversified, thoughtful investments, not crazy, but thoughtful investments in the alternative space. And thanks, Richard, for kind of shepherding us through some of this area. I really appreciate you being with us today, and thanks for being here.
Excellent. Thank you very much. Bye.
And thanks everybody for being with us again on another episode of the 4 Stars Today's Market Explained podcast. This one was just to concentrate on a certain area of investing. We'll be back with a market commentary discussion very soon and some other great interviews. So thanks everybody for being with us. And again, thanks, Richard. Take care. All right, we'll leave it there.